So what does it really take to buy a company? I mean, it's not just about having a ton of cash. It's a high-stakes investigation, really. A multi-million-dollar gamble where you absolutely have to find all the hidden problems before you sign on that dotted line. Okay, let's dive into the ultimate checklist for de-risking a company buyout.
So here's how we're going to break it all down. First, we'll set the stage and understand what's at stake. Then we'll follow the money trail. After that, we'll pop the hood and inspect the company's engine room, look at its people and where it stands in the market, uncover any skeletons in the closet, and finally, get to that crucial go or no-go decision.
You know, every single acquisition, every merger, it all kicks off with one absolutely critical question. Get this wrong, and you're looking at a colossal, and I mean very expensive, mistake.
Well, the short answer? A lot. A whole lot. You could be buying a mountain of hidden debt, technology that's about to fail, or even a customer base that's got one foot out the door. The whole point of this process is to look past that shiny exterior and see if the foundation is actually solid, or if the whole thing's about to crumble. And the secret weapon against all these risks, it's a process called due diligence. The best way to think about it is like a home inspection, but for a business. I mean, you wouldn't buy a house without checking the plumbing, the foundation, the wiring, right? This is the exact same idea, just making sure you know exactly what you're buying.
Okay, so where does an investigation like this even begin? Simple. You follow the money. This first phase is all about digging deep into the financial records to see if they tell a story of consistent success or if there's a story of struggle hiding in there.
Investigators, they start with the core documents, but they aren't just looking at a snapshot from last quarter. No, they are digging for patterns across years of audited statements. They're hunting for trends in cash flow, uncovering any hidden debts, and, this one's critical, making sure all the taxes are paid up and in order.
So you might be wondering, why look back so far? Well, because anyone can have one good year, right? A lucky break. The real question is whether that profitability is a stable, long-term trend or just a fluke that's going to vanish the second you take over.
All right, once you've made sure the money is solid, it's time to go inspect the engine room. You've got to figure out, is this company a well-oiled machine or is it, being held together with duct tape and a prayer?
This is where you really get your hands dirty. You're looking at the supply chain, the core processes, the tech they're built on. Are they running on modern systems or some ancient software from a decade ago? Do they have valuable intellectual property, strong cybersecurity? And what about the future? Is there an innovation pipeline? At the end of the day, the operational review really comes down to this one thing: figuring out the company's true capability and its efficiency. Is it actually ready for the future that you have planned for it?
You know, a company is so much more than just a balance sheet and its production lines. The investigation has to turn to its two most valuable, and let's be honest, often most volatile assets, its people and its reputation. So here, investigators are asking some tough questions. Is the leadership team actually strong? And are they likely to stick around? Is the staff happy? Or are they leaving in droves? And in the market, what's their real share? Who are their biggest competitors? And maybe most importantly, how much do their customers actually love them?
And understanding that competitive landscape, it's absolutely vital. Investigators will literally map out the market share to see right away if the company they're looking at is a dominant leader, a solid contender, or maybe just a minor player that's struggling to keep up. And speaking of red flags, one of the biggest ones investigators look for is this: an over-reliance on a single customer. I mean, think about it. If a company's entire success hinges on one major client, you're not buying a stable business. You're buying a massive risk. If that one relationship sours, the company's value could just plummet overnight. All right, now we get to the fun part, the real detective work. This is where you actively go looking for the skeletons in the closet, all the legal and regulatory problems that can quietly sink a deal, or worse, become your personal nightmare after you've bought the company. This part of the search is really about navigating a potential minefield. Are there pending lawsuits that could cost millions down the line? Is the company secretly infringing on a competitor's patent? What about compliance with all those complex labor laws or environmental regulations? Any one of these hidden bombs could go off long after the deal is signed, leaving you to clean up the mess. Now, finding all these issues is just step one. The next, and maybe more important step, is to turn that messy list of problems into a clear risk profile.
Each potential risk gets systematically categorized. Its severity gets assessed, is it high, medium, low? And then investigators ask the key questions about how to manage it. It's a structured process that's absolutely essential for making an informed decision. So, we followed the money, we've inspected the engine, met the people, and uncovered the skeletons. Now all the threads of this entire investigation come together for the most important part of all, making the final call.
The final judgment really follows a clear logic. First up, does this company actually fit with your strategy and your culture? Second, you weigh all the evidence, the good against the bad. And finally, you make the call, a confident go, a firm no-go, or maybe a go but at a much, much lower price.
And this really brings us to the tension at the very heart of every single deal. On one side of the scale, you've got all the company's strengths, its great market position, that unique tech, but on the other side, you've got all the risks you just uncovered. The lawsuit, the over-reliance on one customer, the outdated systems. The entire decision just rests on which side weighs more.
Because after all the checklists are done, all the spreadsheets are filled out, all the analysis is complete, it all boils down to this one final question. It's the multi-million-dollar judgment call that defines every major acquisition. Is the potential prize truly worth the risks you just spent so much time and effort to uncover?